Today is March 1st, 2026, and the number you need to know before anything else is 318.5. That is how many metric tons of silver are currently sitting in Shanghai Futures Exchange warehouses. Back in November 2025, that same number was 559 tons. So in roughly 14 weeks, the Shanghai vaults have shed 240.5 metric tons of silver, a 43% decline in one of the most important physical storage hubs on the planet. Let that sink in. Now here's the part that should make you sit up straighter. The price of silver on March 1st is trading around $93 to $95 per ounce on COMEX, up about 7.9% in a single session this morning alone. Silver is up over 25% year to date, even after one of the most violent crashes in commodity history. So vaults are emptying at a historic rate, and the price is still elevated. That is not a contradiction. That is the market telling you something fundamental is changing, and today we are going to work through exactly what the data says, where it comes from, and what it realistically means for where silver goes from here. To understand why the Shanghai vault number matters, you need to understand how physical silver markets function. The Shanghai Futures Exchange, known as the SHFE, is not a speculative paper market in the way most Western audiences imagine futures markets. SHFE silver contracts are physically settled by default. When a participant buys a contract and holds it to delivery, real silver bars move into or out of registered exchange warehouses. So, when vault stocks fall by 240 tons in 14 weeks, that is not a paper entry being erased. That is physical metal, in bar form, leaving certified storage. The CEIC data service, which tracks SHFE warehouse stock daily from official Shanghai Futures Exchange data, confirmed the February 4 reading of 423 tons, down from 449 tons just the day before. The trend line across the past 3 months has been consistently downward, with almost no interruption. Why does this matter globally? Because for years, China functioned as a kind of overflow valve for the international silver market. When Western exchanges faced delivery pressure, refined silver from Chinese smelters and storage facilities could, in theory, flow outward to ease tight supply. That valve has been closing. In late 2025, China began classifying silver as a strategic material, which effectively restricted export flows. Chinese silver exports had already hit a record high of over 660 tons in October 2025, as traders rushed to ship metal to London and New York to capitalize on a massive pricing gap. But as of early 2026, that arbitrage window has narrowed dramatically, and the regulatory environment has shifted. The ING Commodities team noted in late November 2025 that SHFE warehouse stocks had already hit a 10-year low at that point, with only 531 tons on warrant. We are now well below that, at 318.5 tons. Think about what I just said. We broke a 10-year low in November, and then we dropped another 200 tons on top of that. Now let us move to the western side of the ledger, because what is happening at COMEX in New York is equally striking. The commodity exchange, also known as COMEX, which is operated by CME Group, holds physical silver in registered and eligible vaults. Registered silver is the category that matters most. It is the metal formally designated as available for delivery against futures contracts. As of February 27, 2026, registered COMEX silver inventory stands at approximately 86.13 million ounces. In April 2020, that same figure was 240 million ounces. That is a decline of 153.87 million ounces, or 64.1% over 6 years. And within the last few months alone, the drop has been accelerating. On February 11th, official CME depository data confirmed a single-day negative adjustment of 3.256 million ounces in the registered category, pushing total registered silver below the psychologically significant 100 million ounce threshold. The eligible category saw withdrawals of more than 4.7 million ounces in that same 24-hour window. Metal is not moving between vault categories. It is leaving the vault system entirely. Now here's where the March delivery situation becomes genuinely critical to pay attention to, because the timing is not coincidental. February 27 was COMEX first notice day for the March silver contract, meaning holders of March futures must now declare their intentions, roll their position forward, settle for cash, or demand physical delivery. As of that first notice day, 10,526 contracts were standing for March delivery. At 5,000 troy ounces per contract, that represents 52.63 million ounces of physical silver being demanded from a registered inventory of just 86.13 million ounces. That is a coverage ratio of roughly 1.64 to 1, meaning for every bar in the vault, there are already claims on 60% of it from just the declared delivery demand on day one of the delivery window. And March is traditionally the single heaviest delivery month on COMEX. More participants will continue to declare physical delivery through the month. To put that in historical context, consider what happened in January 2026, which is a minor delivery month. In just the first 7 days of January, 33.45 million ounces of silver were physically withdrawn for delivery, approximately 26% of the entire registered inventory in 1 week. January delivery volumes in prior years typically ran between 1 and 5 million ounces. January 2026 came in 7 to 10 times above that historical baseline. February 2026 then delivered 5,036 contracts, totaling 25.18 million ounces, the highest February delivery volume ever recorded in modern COMEX history. January and February are both minor months in silver. March is the major event. The structural pressure heading into March delivery is not a rumor or a forecast. It is a matter of arithmetic sitting in publicly available CME Group data right now. The technical condition of the market reinforces the physical data. COMEX silver is currently in backwardation, meaning the spot price is trading above the futures price for later dated contracts. This is unusual and significant. In a normal commodity market, futures trade at a premium to spot because there are storage costs and time value of money. When that relationship inverts, it means buyers are willing to pay more for metal right now than for metal delivered in the future. Markets price urgency. Backwardation in silver is the market collectively saying that immediate physical access to real silver is worth more than a paper promise of silver tomorrow. According to a detailed analysis from Seeking Alpha, published on February 26th, the silver market is simultaneously in backwardation, facing high demand, trading near record prices, and experiencing metal leaving the vault at a rapid pace. Those four conditions together constitute what commodity analysts describe as a physical squeeze in its early or developing stages. It is important to be precise here about what a physical squeeze means and does not mean. It does not mean silver is about to disappear from the planet. Above-ground silver stocks worldwide are substantial and dispersed across ETFs, industrial stockpiles, private holdings, and government inventories. The iShares Silver Trust, known as SLV, alone holds billions of dollars worth of silver and had over 95 million ounces flowing into ETF structures in just the first half of 2025. What a COMEX physical squeeze does mean is that the silver formally designated as deliverable at that specific exchange in that specific delivery window becomes a constraint. When open interest, the total number of outstanding futures contracts, represents 400 to 500% more silver than sits in registered vaults, the math of who gets metal and who settles for cash becomes a real question that markets have to solve in real time. As the Samco Securities Analysis noted, paper exposure currently exceeds available registered stock by over 400%. The structural backdrop behind all of this vault movement is a persistent supply deficit that is now entering its 6th consecutive year. According to data cited across multiple analyst reports, including from the Silver Institute and referenced by Bank of America and ING, the cumulative silver supply deficit since 2021 has reached approximately 820 million ounces. That is close to 1 full year of total global silver production, which runs around 800 to 900 million ounces annually, including mining and recycling. The deficit is driven by a combination of factors that have not changed meaningfully. Industrial demand has outpaced mine supply for 6 years running, driven primarily by photovoltaic solar panel manufacturing, electric vehicle components, and electronics. Silver is used as a paste in solar cell production to conduct electricity, and as solar deployment has scaled globally, the demand for silver in that application alone has grown from roughly 50 million ounces per year to over 200 million ounces annually. On the supply side, silver production is largely inelastic in the short term because approximately 75 to 80% of silver comes as a byproduct of mining for copper, zinc, and lead. Higher silver prices do not automatically stimulate more silver production unless base metal economics also justify expanding those mining operations. Fresnillo, one of the world's largest primary silver miners, announced that it is cutting its 2026 production targets to a range of 42 to 46.5 million ounces, down from its previous range of 45 to 51 million ounces. That reduction in production guidance from a single major producer is a real number in the supply column, and it illustrates the broader challenge. Opening a new silver mine takes 7 to 15 years from exploration to production. No matter how high the price goes this year, the supply response cannot arrive until well into the next decade for any mines that are not already in advanced development. Now let us look at the price action itself in its proper context, because the story of the last 5 weeks has been extraordinary and confusing in equal measure. Silver hit an all-time high of $121.64 per ounce on January 29, 2026. Then, over the following week, it crashed nearly 47% to $63.85 by February 6th. That is a loss of roughly $58 per ounce in 7 trading days, one of the sharpest corrections in silver's modern history. Since February 6th, the metal has staged a recovery of more than 32%, trading around $93 to $95 by the end of February and into March 1st. Year to date, silver is still up more than 25%, even after living through that violent round trip. The gold-to-silver ratio, which is a widely tracked measure of relative valuation, currently stands at approximately 57.6, with gold trading at $5,209 per ounce as of late February. Historically, the average gold-to-silver ratio since 1970 has been around 55, meaning silver is trading at a modest discount to its long-run average relationship with gold. During the peak in January, that ratio compressed dramatically as silver outpaced gold's gains. During the February crash, it expanded again as silver sold off harder than gold. The current ratio of 57.6 sits close to the historical mean, which does not signal dramatic undervaluation or overvaluation on a ratio basis alone. What does the Commitment of Traders report, published by the U.S. Commodity Futures Trading Commission, tell us about market positioning? The COT report, dated February 17, shows that managed money, the category that includes hedge funds and commodity trading advisors, holds a net long position of just 5,472 contracts. During silver's rally to $121, hedge funds were positioned at multiples of that level, likely in the range of 40,000 to 60,000 net long contracts or higher. A reading of 5,472 contracts means the professional speculative community has been almost entirely flushed out of their long positions. The January crash did exactly what crashes are designed to do. It forced out leveraged longs through margin calls and stop-loss triggers. The implication that this creates is counterintuitive. With hedge funds sitting on the sidelines at minimal long exposure, the next leg upward in silver, if and when it comes, would require institutional money to re-enter. And institutional money tends to re-enter in size. The entry trigger most analysts point to is a confirmed daily close above $92, which would validate the technical cup and handle formation visible on the daily chart. Silver is trading right at that level as of today, March 1st. A few major institutional forecasts are worth laying out clearly and honestly, because the range of views among serious analysts is genuinely wide, and that width itself is informative. JP Morgan's global research team sees silver averaging $81 per ounce across 2026, a figure that would represent more than double the 2025 average. They note that tariff uncertainty, particularly around any potential Section 232 tariffs on silver imports, remains a key wildcard that could create sharp, localized price spikes if supply flows are disrupted between regions. Bank of America's head of metals research, Michael Widmer, has maintained an extraordinary forecast range of $135 to $309 for 2026, based on gold-to-silver ratio compression scenarios. That upper range is a tail risk scenario dependent on a full breakdown of the paper-silver system rather than a central case. The median expectations across the broader analyst community, as compiled by sources like Trading Economics, point to a range of roughly $83 to $99 by the end of Q1 2026, with a 12-month recovery potentially approaching $99 to $100. These are informational targets, not certainties, and the range of outcomes from $70 on the downside to $150 or beyond on the upside reflects the genuine uncertainty in a market that has behaved in genuinely unusual ways. The key risks to the downside are real and should not be dismissed. A materially hawkish shift by the Federal Reserve, if U.S. inflation data comes in hotter than expected and the Fed signals it will not cut rates at all in 2026, would strengthen the U.S. dollar and pressure all precious metals. The dollar index currently faces weakness as markets price in approximately 50 basis points of Fed cuts in 2026, and the BOJ is expected to raise rates by 25 basis points, which has pushed the yuan to a 2.75-year high against the dollar. If that macro backdrop reverses, silver would feel it immediately. Additionally, there is the question of whether the silver market's backwardation and apparent physical tightness translates into an actual delivery squeeze or simply resolves through cash settlement, eligible to registered vault transfers, and the gradual unwinding of open interest. COMEX has mechanisms to manage delivery pressure that have worked in the past, and it would be wrong to assume that the current inventory situation automatically leads to a systemic failure. That said, what is different in this cycle compared to prior periods of silver stress is the geographic fragmentation of supply. In previous tight markets, arbitrage flows between London, New York, and Shanghai helped equalize physical availability. In 2026, those flows have been disrupted. Chinese export restrictions mean Chinese metal cannot freely move to Western vaults. London silver stocks, which were already being drawn down through late 2025, cannot easily be transferred to COMEX registered status. And the combined COMEX plus Shanghai drawdown of roughly 161 million ounces over the past 6 years represents 19.6% of the 820 million ounce cumulative deficit. The exchange inventories are not just shrinking in one place. They are shrinking simultaneously across the major global delivery systems, and the regional barriers that used to allow arbitrage rebalancing are now less effective than they were before. If you are watching this and you currently hold physical silver, the most important thing to understand is that the structural case for silver, the supply deficit, the industrial demand from solar and EVs, the declining mine output, the tightening exchange inventories, has not changed because of the price crash in January and February. If anything, the crash accelerated the delivery drain by shaking out paper holders and leaving the remaining open interest dominated by participants who want physical metal. The question of whether you should add to a position, hold, or reduce comes down to your time horizon and your tolerance for the kind of volatility that turned a $121 high into a $64 low in 6 trading days. That is a 47% drawdown. That is a real risk, not a theoretical one. Silver has done this before. In 1980, silver reached $49 per ounce before crashing back to $11 within months. In 2011, it surged to $49 again before losing more than 60% over the following years. High prices in silver are not permanent just because the fundamentals are strong. What the data does suggest, taken together across the SHFE vault readings, the COMEX registered inventory, the backwardation, the COT positioning, the physical delivery volumes, the supply deficit, and the macro environment of a weakening dollar and anticipated rate cuts, is that the silver market is operating under tighter physical constraints than at any point in the past decade. The 240-ton drawdown from Shanghai vaults, the 64% decline in COMEX registered stocks since 2020, the record February delivery volumes, the 400% paper-to-physical imbalance, and the 6 consecutive years of supply deficit are not individually definitive signals, but together they describe a market where the available cushion between paper promises and physical reality has been shrinking steadily, and where the next major delivery cycle, March on COMEX, will be watched extremely closely by everyone with exposure to this market. The most honest summary of where things stand on March 1st, 2026 is this. The Shanghai vaults are at their lowest level since at least 2021, having shed 240 tons in 14 weeks. COMEX registered inventories are at 86 million ounces against declared March delivery demand already representing 52 million ounces of that. The market is in backwardation, which means physical metal is commanding a premium over paper promises. Silver has recovered 32% from its February low, but remains 22% below its January all-time high. The professional speculative community is at minimal long exposure, meaning they are not driving the price. Physical buyers are. And the structural supply deficit that has persisted for 6 consecutive years has not been resolved, while major producers like Fresnillo are actually reducing their production guidance. How all of this resolves through the March delivery window and into the second quarter of 2026 is genuinely uncertain. But the data that leads into that resolution is clear, it is public, and it is available for anyone who wants to follow it directly through CME Group delivery reports, SHFE weekly warehouse data, and the CFTC Commitment of Traders publication every Friday. That transparency is the best tool you have for forming your own view of what comes next.